addition to the final piece of the puzzle, we have already seen the risk-free rate, we've already seen the equity risk premium. We are now going to look at the third piece of the puzzle, which is the beta. The beta of the stock is essentially what we call as the systematic risk that a particular stock adds to a well-diversified portfolio. That's the standard definition under capital asset pricing model. It's a parameter which is unique to each security and perhaps one of the most important concepts in this traditional finance that we're looking at now. This is a measure of the risk of the asset, a stock, with respect to the market. In other words, it is the risk that the stock will add to the market portfolio. Remember, we are assuming that there's a fully diversified investor who's sitting here, and that market portfolio is going to add a new stock. The risk of that stock is what is called as the beta. Now, how do you get to this? The mathematical formula is obtained by standardizing covariance between the asset returns and the market returns, and then dividing it by the market variance. In other words, covariance of the security and the market returns divided by covariance of the market returns with itself. Covariance of the market returns with itself is the variance of the market. Now, the mathematics aside, we don't need to really get into this detail of the formula. It's the amount of times an asset's return will be that of the market returns. What does that mean? It means that if the beta for a stock is 1.2, then historically it has moved about 1.2 times the underlying market. If the market goes up by 10, the stock is likely to go up by 12%. If the market goes down by 10%, then the stock is likely to go down 12%. Thus, what is assumed is there is a linear relationship between the stock price and the market index, right? So if you have the market return here, then you are saying that the stock return is moving beta times the market return and maybe plus some constant, right? In other words, you are saying y is equals to mx plus c, which is the equation of a linear relationship, correct? If you remember mathematics, we used to use this equation, and this equation can be found by a simple linear regression. So if you take two data points, the returns of the stock versus the returns of the market, and you do a regression on them, you calculate a regression on them, that's going to give you this equation. The slope in this particular equation is what is going to be the beta, right? The slope of this equation is what is going to be the beta. So it must be possible to find using this regression what is going to be the answer, right? And that's what we're going to try and do that. Now there are two ways to calculate the beta, and we're going to practically try and approach that entire calculation. The first way is a historical calculation. The stock returns need to be regressed against the market returns. The slope of the regression line, we just saw that y is equals to mx plus c, is going to come in. There are three decisions that you have to take. What is the length of the estimation period? Are you looking at 1 year, 2 year, 3 year, 4 year? What kind of data? What is the return interval? Are you looking at daily data? Are you looking at weekly data? Or are you looking at monthly returns, right? And what is the market index? Are you looking at the Nifty, or are you looking at the Sensex, or are you looking at the BSE 200? What is the index that you're choosing, right? Now, typically, if you're looking at this return interval, as you move from daily to monthly, the volatility decreases. A stock can be extremely volatile day to day, but on a weekly basis, that volatility goes down. So it gives you slightly better estimates over the longer period, right? Again, length of estimation period, longer periods typically give you better estimates, because in the last 1 month, the stock could have been extremely volatile purely based on some news, right? Now, there are some functions in Excel which basically directly give you the data points. You can calculate the slope of a line using a function called slope, or something called as line est for line estimate. You can also do a regression, but the regression is anyway going to give you the same data, so we can directly use these functions which are available. And we can also calculate it using this formula of covariance versus variance, right? So let's try and see this calculation for any particular company. Let's try and do this for Reliance Industries. We need to choose an index. We can choose the BSE Sensex for that. And we need to choose a return frequency. We can say daily or weekly. And let's take 1 year data, the last 1 year data, right? Or data starting on a particular date till today. We can use that data, right? So we can go to either NSE India as a website, or we can go to Yahoo Finance as a website. Let's try and